This level here, the 20,001, that is the rejection block from the daily chart, which you'll see in a moment. This is the full daily volume imbalance. And some of you probably were on the assumption that you had yours filled in before mine. That's because you probably had settlement toggled on your daily chart, and I'll show you what that means in a moment. This is our new day opening gap for today. You see the reference points over here. And then I'll get into the business of all this stuff here because that's going to be an answer to one or two of the questions that I'm going to propose to you. So it's tapping that rejection block. Let's go out to the daily chart real quick and I'll walk you through this because we're a couple minutes away from the opening bell. Now, if you look at what we have here, this is my daily volume imbalance. This is the one I was using. If you look in the lower right-hand corner, you'll see SET on TradingView. Okay, if you toggle that, see what it does? It changes the volume imbalance. Many of you probably had your volume imbalance set to that. I'm looking for PV arrays, whether I'm using the settlement price toggled on or off. Now, I'm showing you here, this is what you probably had on yours. That's not a problem, that's not a mistake. It just means that you didn't do this to see the wider volume imbalance that was there. I'm always going to afford myself the range that's a little bit beyond where the initial one was. So if there's a fair value gap, one toggle of settlement used or not used, and it's broader and wider, I'm going to elect to use the wider one. The same thing happens here. This is the one I'm using. That's what's on my chart, okay? When we traded up to this candlestick right there, remember, this is what I said. Well, we went up to this part and we had that remaining portion left. And then it traded through it. But volume imbalances are what? Inefficiencies. And inefficiencies are gaps. The idea of toggling back and forth, I see this rejection block, okay? But the same thing, I want to see where does that candle body go if I toggle it off. And that's why that's my rejection block, because it's the one that's further away. Further away from where, ICT? Well, when it's down here and I'm reaching up for them, these are premium arrays. When price was below this volume imbalance, like that, and we're below it down here, that's a premium array. We want to see it dig into that. Go back and listen to Tuesday's August 13th, 2024 live stream. Towards the end of the live stream, I walk you through the daily chart. Okay, I'm showing you all the levels. The rejection block was the next, then we have consequent encroachment of this wick, and then we have the high where the buy side is. And I said, ultimately, as long as nothing happens in the Middle East, we're probably going to trade up into this inefficiency here. And I'll have to see how we trade in there to determine whether or not I feel convicted enough to go into this high here. But you can see that's where we reached into. Now, we have continuously pressed in, and I told you that it's not likely to be sustained having this many days up without a down closed candle. So it's unsustainable. And that's why we had this singular down closed candle, which is good. You want to see that. And you want to see, does price respect that? It trades above it, yes. And today we opened, traded down into that candle and then rallied back up. Where is it reaching into? The rejection block that you toggle here. Now, so we're getting ready to trade into the midpoint of this wick if we continue higher. So let me mark that and then we'll drop back down lower time frames and I'll continue with this carnival-like atmosphere. Drop down to a 1 minute chart. So there is consequent encroachment on that premium wick, okay? So if we trade to this above it and come back down and treat it as support, because now we're in the opening. So now we're in the opening range. Opening range, not opening range gap. Opening range gap is this, sessions to regular. This is your opening range gap. Previous settlement, day session. Here to the opening, first print. Okay, so that's your opening range gap. If we toggle this back to electronic hours, there's your gap. That is the wick's consequent encroachment, midpoint of the wick on the daily chart. It does not need to trade there. but we have a gap here. So this is the highest probable, I was saying this many times before, but this is the highest probable location. When you have a gap, the first thing in my mind is, do we have the ability, the interest, the speed for price to reprice to half of the gap? This is where we closed at yesterday's settlement price using day session hours. That price here is the low of the opening range gap. The first print at 9:30, that's your opening tick on this candle right here. That is the high. They don't change. These levels do not move around. They're not dynamic. But the opening range, which is the first 30 minutes, that is a dynamic range. It can expand throughout the entirety of that 30-minute time frame. Meaning, right now, the highest high is here. So it's this. We have this. All right, and this is the lowest value right now. The opening range is what we're watching. Do we have a fair value gap form? So inefficiency. The very first fair value gap that forms after 9:30 in this first 30 minutes interval is such a fucking powerhouse. So this is our opening range. So it's a time period. Okay, it's a time period that begins at 9:30 and it goes up to 10 o'clock. That is the real opening range. The algorithm refers to this. So what your interest is you want to see what this dynamic range in time is doing. What's the highest high and the lowest low? And the first fair value gap that forms in this first 30 minutes, you want to extend that throughout the entirety of the day. Okay, all the way until 3:45 Eastern time, New York local time. You'll be surprised how often amazing, I'm talking amazing trades will form off that first fair value gap in that 9:30 to 10 o'clock interval, that opening range. I do not want you to take my word for it. Okay, I've taught this in private mentorship. I've taught this and mentioned it in Twitter Spaces last year. I think if I'm not mistaken, last spring. I talked about how you can do this. Okay, and because I have so many concepts, like I said, I got 81 of these things, 81 of them, and they're not all just inversions of one thing. They're individual things, and they themselves are invertible. So right now, this is the lowest low. We want to see, does it expand down through it? The first probable level is that midpoint of the gap, and that gap is the opening range gap. Generally, when I'm actively trying to take a trade, I'm looking at the 15, the 5, the 1 minute, and then I have that matrix template that has all of the 5, 4, 3, 2, 1, and then I have a 45-second chart, a 30-second chart, and a 15-second chart. And I'm looking for the first fair value gap that forms in those time frames if I have a bias. So right away, I want you to think, I've said it before, it's not a panacea. It doesn't mean it's going to work every single time. But whenever you have a gap up, now, when it gaps up like that, you want to find the midpoint of that, because many, many times you're going to see it trade to that level. It may afford you a setup. If there is a setup that yields a run from, say, maneuvering something up here off of a premium rate and starts to break down, and you get a fair value gap, say on a 15-second chart or 30-second chart or 45-second chart or the 1 minute, and it affords you a range from wherever that gap is to the midpoint of the gap, that could be your very first training wheels. It's the focal point for the daily range. Until we enter a trending day, that fair value gap can be used multiple times for multiple trades, both directions. But the mid part of that gap, whether it's an up gap, okay, so this is a premium gap. Why? Because we gapped higher than where we settled. So this is a premium opening range gap. If we gap lower than the previous day's settlement, and we say we open down here, that is a discount opening range gap. Okay, very simple. Same thing, as soon as you get the first tick at 9:30, you want to throw a fib on that just to get the midpoint. it's a 70% chance that that mid-gap level is going to get hit. Now, that doesn't mean that you're going to get a 70% chance of getting an entry that's profitable, that never got stopped out, that never had drawdown. It's just going to be a straight line run right to the mid part of that gap. It doesn't mean that. What I'm saying is 70% of the time from the opening price to 10 o'clock, that level gets hit 70% of the time. It can, but you don't need this initially. It can go all the way back down and fill in the gap. Another instance is when you have this measurement like this and you know where you have the higher gap opening and we're in a premium gap. You want to measure where your quadrants are, upper and lower. Many times you'll see it go down and leave a smaller portion of the gap opening, which is really what I love seeing that. Because say, for instance, say we're bullish, okay? Say we're bullish and we think price is going to go higher. What happens if it doesn't go down here and touch the midpoint of the gap? It means it's really, really bullish. The examples I've shown where I've entered in before 10 o'clock, it's using this logic. And then I'll have a runner that would hopefully probe any movement below the midpoint of the gap to see if I can get down to the lower quadrant. And then all of a sudden you'll see that's where my other partial was taken. And if I get a gap closure, I'm going to be a little bit higher than the full gap closure because it can do what? In a perfect world, you want to leave a small portion of it open because every gap invite the opportunity that it doesn't completely close in or fill in. That's my main focus so far when I've been teaching gaps in this 2024 is you don't want to see them completely fill in because that's rocket fuel. So we had this one more time. So where we opened down here, 70% of the time. Now this is the old high of that volume imbalance. Watch that level as well. That's why it's there, okay? We're sitting at the top of the opening range here. Now what we like to do is since we hit half of the gap, it's come down there, and then now we're at the top of the gap. Do we have the wherewithal to trade above initial high of the day? And if we do, where can it go? That's what that midpoint of that premium gap on the daily chart is, or the wick of that, the halfway point of the gap that we outlined as that wick on the daily chart. That's what that level is. If we take out the opening range high again and close, if we close above it, anytime that we go below here, opens the stage to come all the way back down to a full gap closure. Otherwise, I'm not interested in going short. It would need to do that. So it has to go below here. When the market's clean, it's easy. Like up, down, all around, buy it, sell it all day long. But when we are in a week like this week, which is what I opened up with on Monday, we are in the week with Jackson Hole Symposium. Okay, so that's the opening range low. And then we are trading at 10 o'clock. One more. 30 seconds will be at the end of the opening range. So then by that, you know you have the low. And whatever the highest high is, that's your opening range for the day. And you want to do quadrants on that and extend that throughout the entirety of the day. And if you have a macro overlap with that, with time, chances are you have a trade, as long as you know what side of the liquidity you're going to aim for. But the week that has Jackson Hole Symposium, and the way you determine that is you simply look at the economic calendar. And it's usually one time a year. And the week that it occurs, that full calendar week, this particular week has a tendency to see price have overlapping price swings, which invites what for market profile? It invites the seek and destroy. It invites the likelihood of, if you don't have a partial taken, chances are you can be stopped out and have nothing to show for it. Even with like a 7,500 handle run, it can come all the way back against you and then run again in the same direction. So we went above, and now right below this low, we have initial sell side and buy side is here. So there's inefficiency between the low of the opening range, not opening range gap. We're inside the opening range gap, which is that blue shaded area. But we have sell side here and inefficiency down to previous settlement. So this is This is the part that's still open to inefficiency. So this part is the remaining portion that's lacking any buying and selling during the regular hours. It doesn't matter that we traded here in electronic trading or pre-session. It doesn't matter. Always give the opportunity for the day session, which is 9:30 to 4:15, to reprice into this area, both sides. Since there's no trading between the settlement price and this candle's low, there's no buying and selling booked at all, zero. Now, I'm not saying there hasn't been, because clearly if we go to electronic trading, you can see that we did trade through it. See that? So it's lacking what? Sell side. Now, here's a big paradigm shift. Since we passed up through it here, it's lacking sell side. So what kind of price delivery, if it wants to go back to the settlement price of yesterday, if it goes below this low, what type of price action would you like to see? I would expect it to be quick and sudden to fill the gap. So it provides a means of classification on how price should deliver. Now, I would expect if it were to trade below that low to do it quickly. And what else is inside that area? That's today's new day opening gap. So we have a new day opening gap towards the low of the opening range gap and the remaining portion here. So we have to watch this low. What happens if it does this? Say it trades down below and starts to come back up a little bit. What is it doing? Well, it could be taking this wick right here, finding the midpoint of it, hit that, and then expand lower quickly. We have moved to the midpoint or consequent encroachment of that daily volume imbalance. That's that shaded area here, okay? That level right there, the 20,001 level. Do you remember what that was? That's the rejection block, okay? And I have this little line here. I explained to you why it was there. And also you understand that a rejection block can be used as a reversal pattern. That means if we have a high here and we're expecting prices to do what? Gravitate where? Well, we have an opening range gap. So if it can trade to fill the gap, or make an attempt to do so, and we're up here, where should the price draw to? Down. Okay, wonderful. Where can it turn to start going down? Well, you have to know your PD arrays. Initial high, that's the opening range high. If it goes above that and spikes through it, which it could have done before it even did all this over here, it could have went up there and hit that wick of the high on the daily chart. Go back and look at how I walked you through the daily chart. It never traded there. So because it failed to get there on this initial run, here's the opening bell, runs up, next candle slightly higher, and starts going back down. Where is it going back below? The rejection block right there on the daily chart. That's the highest up close in that price swing on the daily chart. We failed to get to consequent encroachment of that wick. Is that bullish or bearish? When we have an opening gap, that's a premium. In other words, we had all this. But this opening and rally up and then going right back down below the low and below that rejection block, we couldn't get to the consequent encroachment of that wick. Well, that's intel. That's giving you what? I can't even reach up here for you, ICT, so start looking lower. Okay. Well, let's wait for the market to do what? Give us the mid gap. Well, it does that. There goes the whole 70% of the time. It was one more time giving you the proof of it. In this leg here, and it starts to rally back up, it goes right above the rejection block. Go back and look at the lecture lessons. Listen to what I'm teaching there. This right here, that is a turtle soup. So, rejection block. It goes above it just enough to reject. Sends it lower. Now, where's sell side? Right below the initial low. That low also is just a little bounce off of the old volume imbalance. So the sell side below here is going to draw to that. That right there, from rejection block to sell side, that may be your trade setup. If you go through all this price action, okay, go through it. What do you see? 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 What is this? Oh, look at that. That right there. That is the very first fair value gap. This is your very first fair value gap that actually runs up into a rejection block with an opening range that has not completely closed in. We did get the halfway of the gap delivered, offering what? Opportunity to see if it can retrace and go lower. When we were trading here, I said, okay, we're at the top of the opening range gap. Once it trades above, it forces, if we trade below here, it will be a full gap closure. So you're watching price here. First fair value gap formed. There is no other fair value gap in here. There is no fair value gap in here. That one is it. Now, if that's your fair value gap, and we went back below the opening range gap high, as soon as we do that, that is indicative of what? Seeking that where the sell side is. And if it's going to go there, it's going to be a full gap closure. If I was short, I would take partials just above the full gap closure. Why? Because sometimes the gap won't fully close, and then you can see it run and take out the relative equal highs. If it goes back into the range, it's going to go here. If it's going to go here, it's going to be a gap closure event. So how will we use that fair value gap if that narrative and logic is in play? Wait for it to trade down below it, then trade back up into it. Then, what was I walking you through? How would you want to see price deliver if it takes out that low? If it goes below that low, the style and the characteristic of that delivery should be sudden. It should be quick. And here's the SIBI high. So we traveled all the way down to the lower quadrant with the bodies of that old, should have been thrown away if you listened to everybody else, volume imbalance. Let's go back out just for a moment. If we toggle this back, you can see that's the volume imbalance. And if we anchor a fib to that, you always want to do this on the time frame that the imbalances are forming. So now we have one with our quadrants, and I'm going to take that extension stuff off because, oh, no, I think that was me measuring that wick, isn't it? Yeah, that's good. So we'll take that off there. We don't need that now. The midpoint or consequent encroachment and the lower quadrant and upper quadrant is now toggled. This candle's low right here, the down close one with the long discount wick. That right there, that low is the high of this SIBI. All this one singular candle to that. So in other words, you would see it like this labeled. If I was showing it to you with a naked chart, nothing else annotated, it would be me highlighting that, this area here. And it would look like this. Okay, and I would just extend it over. So we're seeing the high of that. So since price is above it and we're coming back down, that old array is what kind of array? It's a discount. Price is going to draw to it. It can draw to it. It can draw down to it, go through it, and come back up and treat it as what? A premium array. So 1 minute chart. And here we have the quadrants. Okay. And disregard, I know it's hard to do it, but disregard this new day opening gap for a moment. Kind of like ignore it being there. We have the high of that shaded volume imbalance on the daily chart. This is the upper quadrant to it. Midpoint is this. There's consequent encroachment. It's red. And then you have the lower quadrant level. And you have the low of it. We traded down. We created a fair value gap right there. And just above a new day opening gap for today. So what does that mean when we're down here? We can go above it. How far? Fill in the fair value gap. I like that because it's laying right on top of the upper quadrant. So are we looking at just a closing of a fair value gap? No. So if we have this fair value gap and a new day opening gap, we know that it can sweep above it. It need not just trade to it and drop down. No, that's not how it works. Where's the inefficiency? Right there. Do we have something in agreement with it? Just not by a fair value gap alone. What else is in close proximity to it? Inside that volume imbalance, that shaded area, the upper quadrant level is there. Where does it trade to? Boom. And then what does it do? Low, low. Low higher than that low. So what's below that? Sell side. Fair value gap closed? Yes. Bodies nowhere near closing on them, on that level. And where does it go? Down. Sell side. That might be your trade. That might be your silver bullet. Think about it. Roll it back. Let's say you saw this gap, and let's say you bought it because you're trying to figure out how to do this stuff. Okay, you're tape reading. You're not buying it per se because you're trying to get a feel for what it is you're supposed to be doing. You're discovering your model. Let's say, and say you say, okay, I'm going to try to buy this, and then it goes down and stops you out. Wonderful. That's a wonderful opportunity because then, because of the rules I just gave you, you know that we have a real strong chance that we're going to take this low out. And if it does, then we have even higher probability than the 70% that when we gap higher at the open, that the midpoint gap will be traded to between 9:30 and 10 o'clock. If it takes out that low, we have a 80% chance that it's going to have a 3/4 closure on the opening gap, opening range gap. So that means we're about right in here. So if it takes that low out, we can have that much of a range. So what happens when we start to rally back up and we see that inversion fair value gap? You already see it failed with your usage of you trying to buy it. And now it's tipped its hand to you. If this goes below here, it's going to go back to 3/4, and then you wait to see if it gives you a full closure of the gap. And if it takes out the gap to the downside, which is what it does here, it trades below the low of the gap. Where's it going to trade to next? Well, in this leg here, is there any inefficiency? Fair value gap. Your eye should jump right to it. What else is there? You can't just have that alone. Support it with something else. Upper quadrant of the volume imbalance. So now you have two things. So where's the liquidity at? If you're going to sell short in there, where's the liquidity? Where's the inefficiency first? Well, you have it right there. But that's not enough to get excited about. So if that's all you saw and you didn't factor liquidity below the lows, that wouldn't be a trade you would take on. But you have a low that's slightly higher than that one. It's too smooth. It needs to be made what? Jagged. Sell short. Engage the sell side. Be done. Be done. Because you've had now 1, 2, 3 legs lower seeking liquidity on the downside. So we've pressed 3 times into sell side. The market is entering, well, we got, was it 10:43? We're getting close to when the market can have a retracement into opposing liquidity. So we've seen sell off, and no buy side except for this one has been engaged, and this. But we had 3 deliveries into sell side. So it's setting up a potential where we can get a intraday retracement. Even if it wants to keep going lower, it's fine. But you have to measure every single time we engage liquidity. If 3 times we go into sell side, or 3 times we attack 3 successive higher levels of buy side or 3 successive lowers of sell side, it opens and invites the opportunity for a retracement, for intermediate term retracement. It doesn't mean that you called the low of the day. It doesn't mean it's calling the high of the day. It just means that you need to be aware that you've done this now 3 times intraday. So it can spool the other direction. And many times that sets up a wonderful continuation to go even lower or even go higher. If it has this very first fair value gap here and we trade below it, what's your mindset going to be? Switch to inversion. Wonderful. So first threshold is, where's the midpoint? That's here. Consequent encroachment. Do we want to see it if it's a valid inversion fair value gap? Okay. If it's a valid inversion fair value gap, will it, remember, I'm just going to be asking you questions today. Will it completely overlap? In other words, will it go below it and come all the way back up and touch the high of the old gap? No. And that's exactly what you want. You want to see it fail to close that in as it goes back up. It's leaving a portion of that candle's low and that candle's high. In other words, it looks like this. That's the portion that didn't close in. But you don't want to see that complete closure, because that's a signature that there's an algorithm saying this should close in, but I'm not going to close it in. And that's a tip off. When you see it trade up in the inversion fair value gap, that's your proper use of the very first fair value gap. It's changing the state of delivery, just like an order block will. Okay. Order block, we don't want to see it go, and when it's a bearish order block, we don't want to see it trade above mean threshold. We want to see it dig up into it and then roll over and go lower. Reverse it for bullish order blocks. We do not want to see it go below mean threshold, half of its range. Why? Because the strength is indicated by its inability, its reluctance to get to the furthest extreme. Which is why, again, this is not supply and demand. Okay? There are schools of thought that will say a fair value gap is best filled. And I teach that it's not so. You want to see weakness and failures with these PD arrays. The failure for this candle or any subsequent candle to get to the high end of that fair value gap, to close it in other words, to get all the way back to this candle's low is what I'm saying essentially. A perfect redelivery would be this candle or any other candle trading up into and touching the equivalent low of that candle right there, which would be 19,979.25. As we have this, we have 19,977.75. So we fell short of that, right? To the tune of the range between that candle's high and that candle's low. That's exactly what you want to see, which is the confidence factor that was given to me when we were down in here. I said, how do you want to see it deliver? And I walked you through the choices. It can go below that low here. And this is where every troll was jerking off saying, here it is, here's where I'm going to go and go on social media in another person's chat and say, I hear his ICT calling both sides of the marketplace, but now it's even worse. He's given three scenarios. Okay? Go back and listen to what I was doing. Do you want to see it go below that low, a little bit short and go higher and reverse? Do you want to see it go below it and just dribble down and go slow? Or do you want to see it go below it and then large candles and speed, just like that? You want to see large candles and do it quickly with speed. That's what Price did. Okay? That would be Caleb's entry. That's his model. Not because of anything other than knowing that the gap was here. We failed to get to the consequent cushion of the wick that would have been obvious for it to reach up to. We created a swing low. It traded back to mid gap of the opening range gap and then rallied just outside of the opening range gap. Then rejection block here from the daily chart. Rejection at the rejection block. Trades lower, below the gap. Caleb's school of thought will be, I want to see this gap be overtaken to the downside and then offer me an opportunity to get short. At what price? He will use this candle's high, 19,973.75, minus one tick. That would be what? 19,973.5. That means all it has to do is book that high. Theoretically, that one tick difference should fill him. But I'm affording him the luxury of seeing anything inside this gap. So the rejection block, we trade above that. We did get the midpoint of the gap. So if we go above the opening range gap here and then come back in, the net low is going to be suspect. So if it's going to take that low out, then we go to 3/4 gap closure and then full gap closure. We also had new day opening gap high and low inside of the opening range gap, that blue shaded area. So he would take that trade based on that logic. His stop would have to be above consequent encroachment of this wick. Now, why that? Why not the high of that? Because we already had this low, we drop down, immediate rebalance, then it drops. For continuation, if he's afforded himself the amount of equity that he would carry more than one contract, he can then wait to see if we can get below the new day opening gap, which is what we see here, and then wait for what? A retracement. We have a fair value gap, and this fib is not that level. Upper quadrant agreeing with this fair value gap. So we're sweeping above. See, we're sweeping above the new day opening gap. You want to give the algorithm a chance to move around these levels because there's going to be stops and liquidity, or it will entice traders to chase it. So this type of movement here causes traders to do what? They want to chase it. And if they think they understand fair value gaps, what are they going to do on this little thing right here? They're going to try to buy that right there. So if you know this logic, you can then, once you wait for them to form, Caleb, you extend them forward. When they agree with another reference point, something else, it cannot be one singular PD array. Minimum 2. 3, you got a lead pipe cinch trade then. What's this red line right here? It's consequent encroachment of the old daily volume imbalance. What's it touching right there? That level. That's also part of this inversion fair value gap. See that? The market sells off. Short-term sell side, minor sell side liquidity pool basically, and trades down. We have this low, all part of August 20th new day opening gap. And we have this low. So we have 1, 2, 3 levels that retail is going to see that as what? We're getting a little close to lunchtime macro, so I would like to see it do, if it's going to do it quickly. And then we can attack maybe the new day opening gap here and this high. If it takes that low out, I would like to see that run for the lunch macro. Lunch macro, again, for those that are wondering what that is, the market tends to retrace against the underlying direction that has transpired that morning session. Obviously, I think everyone can agree that it's been dropping since this morning. So this morning we've had trailed stop losses. And then what you want to do is, if we take these lows out, we'll just make it easy. Say these lows are taken out to the downside. And then the lunch macro starts between 11:30 and ends at 1:30. It does not mean there has to be a retracement. You want to look for the opportunity for it to happen. What you do is, you at that time at 11:30, if you see something that is potentially setting up the retracement for the lunch macro, a macro is a short list of directives that is a code, is a script. The algorithm will start running to opposing liquidity. Okay. About to lose my voice. Lord help me. Somebody out there praying, please let him lose his voice. Please, he talks too much. This high, if we go below us, this would be the first high you get to that has to be post 10 o'clock. So here's 10 o'clock. So you would use that as a beginning point. Go to the right, and every high, here, that one, but then we made this high, and then we made this high. So I would use this high as the lunch macro. That's where the market would draw for a retracement during the 11:30 to 1:30 retracement. It does not mean that at 11:30, it's just going to start going up and go right to that level. There's other things that you have to factor in. There's the rundown we were talking about, running those relative equal lows. So what I'm interested in, does it accelerate after taking the next candle, bump the low, or maybe consequent correction on the new day opening gap, and then run that low right there. But look at the reaction off of this gap here. And it's the low of what? The old, stale. I gotta stop. I have to get serious, okay? I gotta get more professional. Look at that. Look, now, if it's gonna go that far, look at the next new day opening gap down here at August 21st. What's the chances it can at least tap into that? Just for shits and giggles. Can it do it? Can it do it? I don't know. Do you need it to do that? If you were short and you were looking for a partial, do you need my invitation to take partials? So I know some of you are already short. If you're not taking profits, some right here, you're full. Take something off right now. But the fair value gap here is also a rejection block. See that up close candle? And what? It's the low of that stale, old daily volume imbalance. That you never would have had that level on there prior to that daily volume imbalance being outlined last Tuesday on August 13th. August 13th. How many times has it used that area? Multiple times. Multiple times it's used it. So we have this midnight, Wednesday, okay? And we cross over to Thursday. Prices trading where? What is it doing here? What is that? Relative equal lows. Okay, wonderful, wonderful. But why is it doing it there? Well, what does it say over here? But the level is the old daily sell side imbalance, buy side inefficiency high. When I took you on the daily chart, remember it was that red box that said if I was going to highlight it, it would be looking like this. That's what it's doing. So when price is above it, okay, when it's above it, how is it going to treat that level? As a discount level. Sweep. What's the body's telling you? It ain't even touching it. What's the body's telling you? It ain't even touching it, but it's a higher low. The market rallies back up. What is it doing in this area? Where is it at? It's inside that old daily volume imbalance. So what I'm giving you a structure in the marketplace, like an X-ray view, a CAT scan, okay? You're able to see behind price action and what the market's really respecting. It's not the buying and selling pressure. It's allowing, the algorithm is sweeping into these levels, crossing over levels, coming back down. And then once you know what the narrative is, where the price can go. Well, what is that? What is that? Over here, what is this? Relative equal highs. What's resting above those relative equal highs? Buy side or buy stops. It's traded down to a discount level or PD array in the form of the daily sell side imbalance, buy side efficiency high. Okay, that is a PD array. That's one of the 81 that I have. Each one of those have a characteristic that can be inverted. So when you are expecting higher prices, which we've been calling, we have not been trying to pick the top. The market trades down outside of the volume imbalance. So where could it trade to? The next PD array on the daily chart was that high, that SIBI. It trades to it here, then moves back inside of the volume imbalance. Inefficiency on the upside after poking its toe outside of the yellow area, which is the volume imbalance. This fair value gap forming when? Look at the time. What time is that? Right there. What time is that? It's 1 minute past the opening range at midnight. Oh, you did talk about that, ICT. You did. You did say, if I want to trade in London, if I want to trade European zone, trade time-wise, okay, you want to trade the Eurozone's opening session? You want to trade London kill zone? You want to trade Asia's close? That reference point there, from midnight Eastern time to 12:30, that's your opening range, okay? First presentation. What is that? First presentation is when you have time of day, because everything starts from time, algorithmically. And first presentation, that means the first inefficiency. You want to take that and carry it through. Cast it forward throughout the entirety of the day, okay? It uses it here and touches it right there. It drops right into that, okay? Here we have 1:50 a.m. right there, all the way over to 2:10 a.m. Everything I'm showing you is the same for British pound versus USD. Same thing for euro versus USD. Same thing for dollar yen. Same thing for dollar CAD. Same thing for Aussie dollar. Same thing for New Zealand dollar versus the US dollar. So Forex, it works the same way. Okay. Please stop demanding that I show examples. I said I would, but when it's salient and it's not something that's only specific to Forex, I can say these things and they're germane. It's the same thing. It's the same thing in Forex, okay? But this is a macro. It's the first one you're going to get to as you enter into London Open Kill Zone, 2 o'clock to 4 o'clock. That's your sweet spot, okay? Then we see it touch that fair value gap, which is first presentation right there, inside of the range of the first 30 minutes, 12 o'clock to 12:30 a.m. Eastern Time. Does it react off of it? Yep. Creates another fair value gap, which is also part of what? What do you see here? Here, here, here. Bullish breaker. So even if you don't see this fair value gap, it's fine because you'll get the breaker there. Drops once more. What is this little indicator telling me right here? $350 to $410. Where'd it trade to? Let's go into yesterday, and with the right volume imbalance on the chart, which is this over here. So we have the volume imbalance here, and I have the quadrant levels there. But I was watching price yesterday, and we did trade up into the volume imbalance, lower half of it, but didn't quite get into the second half. And we had this big dump off here, and it rallied once more. And as we dropped down in, I was watching that new day opening gap on the 20th. I'm thinking to myself, hey, if they can send us on a closing basis below these lows on here, then I'm going to use any return back up into that new day opening gap, hit that, use it as a sell-off, and go lower. And I was going to aim for this, not this, what am I doing? This low here, because it's part of a breaker there. So this high, this low, two forms of what? Discount array. I want to see, does it want to go and close below here? And it didn't do it. And as I was watching it, I was looking at this fair value gap. And because I see that we're now dipping in here, I'm like, okay, I want to catch it on a buy stop. So I go in and I put in a order to buy it as it clears and should breach the consequent encroachment. I want to be in it should it do that. So I heard and grab this and do something like that when it's trading here. So if it's going to go, and if this really is an inversion fair value gap, it's going to be treated as like a springboard. I want to get in there on a stop as it proves it's going up. That way, what it's doing is if it just drops out of it and goes lower and attacks these relative equal lows, I won't be filled. I'm buying the strength that the inversion fair value gap should prove to me with delivery of price because it's already wicked outside of it. See that? So in here, running up, and then we're back down in here in this consolidation, which side would you bet on? Going to relative equal lows or the relative equal highs, but into the area that was not delivered yet on that old daily volume imbalance. When I first was watching it, I thought that these candlesticks were actually closing closer to these bodies. So it didn't register as strongly as it did when I realized, and I was like, oh shit, it has already done it. Like it's done it. It's went down below the bodies here. It's already did the rejection block. That would have been a better entry for me. But because I missed it, I have to now look at this gap that's now here at that candle's close right there. I'm noticing it as I'm looking into this candle, and I'm like, shit, I have two options here. Fix the fair value gap and have it anchored like I have it here, or just go in and just get the fill. So my mind said, if it's going to go, I want to do it on a buy stop. So it means it's got to trade up to my level, like a buy stop would be used to protect a short position. That's the entry mechanism I used. And I was doing it inside of this inversion fair value gap. So in other words, I wasn't looking at it as like it was going to go up here to go down. Initially, I was looking for reasons to try to maybe suggest that it may do that and then catch a smaller immediate rebalance or a fair value gap on a 15-second chart after it respected it. But when I looked at the candle, I was like, oh shit, actually, I'm reading that wrong. I'm going to go in there and treat it as an inversion fair value gap. So I couldn't get it drawn out properly, but you can see it was me obviously buying it. So I went in, put in a buy order on a stop. It fills me. And then you start seeing me measure this wick over here. So I'm looking at this wick thinking, okay, it's going above it. Now I'm going to try to add to it, and I'll put 4 more contracts on as it touches consequent encouragement. I wanted to see that as an opportunity to do so. Go watch the recording. You'll see me doing this. But this thing just starts saying, yeah, I'm going up. And you missed the train. If you ain't already on, you missed it. So it goes up and then eventually finds its way to the high end and then blows out the high of it. And I called the sell side. I said it'd be nice if they could take out the sell side level. But I wanted to see it do this type of thing here up to the top of the volume imbalance and then give me something here. But it really blew out really high. And then all of this, it was so fast I couldn't. Well, I know you're probably thinking, well, didn't you just show us what you did? So I went in buying. Look where the little caret that appears when you highlight your little buys and sells. When you hover over top your arrows, you can see this is not market replay. So this is entering on a stop at the high end of the inversion fair value gap. So I'm getting in on a stop right there. If it's going to go to that level, I'm probably going to be on side, and it would have to be drive up into this here. Once it takes that high out, I'm watching this wick. I want to see it trade above consequent encouragement, that wick. And then I wanted to, and you'll see me, I'm doing the fib on this. It's taken off. Well, I knew at that time I was going to get another pyramiding opportunity. So I just had to work with it. And because it was happening so fast, my mind said, well, what do you want to do here? Do you want to take half off? Do you want to take 2 off? Do you want to take 4 of the 6? What do you want to do here? So I was like, well, fuck it. I'll peel off 4 here. And I was trying to time it right when it touched the upper quadrant level there. So I took that off there. And then finally the limit order fills, and you watch that in the video. And it fills at the high end of the volume imbalance here. All this move here I was not able to be a participant in. I didn't capture any of that move clearly. And this was too fast. It literally was too fast. I was setting this recording up to make the video to go on YouTube when this was happening. When I signed back in to the trading view, once the video was being uploaded to YouTube, it had already been down here. I'm like, shit, I missed a really good drop. Like, man, that sucks because I wanted to do both sides of the marketplace. So, okay, I waited. But when we trade up into the low of that volume imbalance, that shaded in yellow area, okay, what I was watching, and look real close, okay, as we traded up, look what the high of this candle is right there. You're going to look at this value right there, 19,000, what is it? 19,894.5, okay? And the lower quadrant level is here. So it's not touching it, is it? Is that body on there? I'm sorry, not body. Is that wick on there? Touching it? Nope. So what does it do? It trades down. Okay. So what's an ICT order block? What is an ICT order block? It's a change in the state of delivery. Now, I'm going to put the execution back on again. We do not hit it there. And then this candle does what? Comes all the way back down and crosses over that candle's opening price. That is when the algorithm changes. Now we're going lower. We've done the delivery to the buy side, trading right back up into what? The old daily volume imbalance. It's using that same PD array. It's trading up into that, and then I'm waiting for the price to do this. Cross that opening price. Once it does that, these two consecutive candles is my real order block. So when we traded back up into that volume balance low after this big drop off, what's the likelihood of where price is doing this? Is it more likely that they're going to come back down and sweep below the sell side here when we trade at this level, or continue up and take out that high? What do you think the likelihood of this? Clearly, it's going to be exploring the downside, sell side, okay? Why? Because we've been going up for a long time, and we finally worked our way to and through that daily volume imbalance. So it's exhaustive. It's like, I'm just going to throw it all up there and be done with it. And that's what they did. They just pumped it up there real hard and allowed a heavy measure of distribution come into the marketplace. I knew this, and watching the market trade back up into the low of the volume imbalance, then I wanted to see, does my order block give me my signature of when it's going to be good to sell short? Up close candles, your consecutive, opening price, that's your change in state of delivery. It right there gives it to me. It does not, listen folks, it does not require a close below. Okay? It doesn't require that. It's not an engulfing candle that does, fuck all that. That's not what's going on. There's other things that are distinct away from the single up close candle, or in this case, when they're consecutive. All of this is the entire order block. Okay? That's the entire order block. But your eye goes to the opening price, the lowest opening price of the consecutive candles. In this case, it's this right there. When it takes that out there, all it does is have to breach it. That means trade to it and below it, one tick. That activates that right there. And my eye goes right to that, because everything going forward, the algorithm is going to refer back to that same price. Watch. Man, this is almost like a paid mentorship level. You feel like a charter member right now? I don't even deserve this. Why is this guy giving this away for free? I know. It's probably because I got money. So we have the opening price here, and this candlestick crosses over it. Right there at that point, as of 11:16, we are now in a sell model. Okay? This candle, we open right at the low of the volume imbalance. We open, trade up a little bit, come right back down. Next candle, opening, rallies back up. Does it take the rejection block? There. Because if it takes the rejection block, that nullifies the order block. It completely undermines it, says, nope, don't do it. If I have a trade open, I will kill it. And then right here, we cross back down. In here, we do not get the rejection block. And as it was forming lower, as I'm aiming right towards the low of that, I'm getting two things at one time. Failure to get the rejection block, because it should have did it spike right up in it, bang, and done. Because if this is a valid order block, it should not go there. And I'm waiting for that. I want to see it. Okay, it's wonderful. Drop. Right there's my fill. I'm eyeballing it, marketing in. And I'm trying to aim it as it's hitting where the body is starting to drop down, drop down, drop down. I'm trying to aim at it as it's hitting the low of the volume imbalance. That shaded yellow area. That's the same section on the daily chart where there's a section where there's no bodies that overlap or connect. It's just the wicks. Everything we talked about this whole presentation today. So then we close here below that price. Every time we hit that, does it support lower? Lower high, yep. Lower, yep. Only going back up into this candlestick here. Sell off. Adding to it. I'm pyramiding. What am I adding into? I'm adding into the low of the new day opening gap on the 20th, right here. The market breaks lower, comes one more time. What is it hitting here? That's the daily SIBI high. Hits it here. here. What's this? Rejection block. There. Sells off. What's below here? Sell side. What's these levels here? New day opening gap. When do you get that information? 6 p.m. on the 20th. I'm aiming for sell side below here, and I'm trying to reach below to take the sell side out below here. How did I get to that level? These prices here. How did I get to these prices? Here's a consolidation. I want 1/2 of that consolidation out. That's a standard deviation. Oh, ooh. That's a pretty good place to take profits, isn't it? As it's aiming in, hitting it, I'm trying to get out with the sell side. I don't care about all the bottom tick, scavengers. I don't worry about all that. Your heroes don't have trades like this, folks. Okay, I promise you that. They don't have it. They have mentorships, but they can't trade like this. They cannot trade like this. Period. End of story. Not happening. Okay, so I went long based on experience, and I knew that it pulled some shenanigans is basically what it is. I knew this was manual intervention. That I knew they were going to gun the high. I knew they were going to probably take it up to the high of the volume bounce. I knew that much. And then it was a little overzealous on the upside. So I was right about picking the time when they were intervening. I am not able to do this consistently, but there are a few times, and I mean this very, very few times, when the markets are conducive for having these seek and destroy events, which the characteristic of this week is what I told you on Monday in our live stream. I said, be aware that we have Jackson Hole Symposium. Jackson Hole Symposium. So if you look at the economic calendar, you'll see it looks like this. Anytime going in the future as a trader, when you see that the economic calendar has that on it, you're going to have delivery of price that will overlap back and forth, up, down, up, down, up, down, up, down. And it can invite the conditions that is seek and destroy. If you take trades, if you take trades that if you don't take partials, let's put it that way, you're going to give up the best wins and you'll overstay your welcome. And since we had day 1 of the symposium today, tomorrow's day 2 on Friday, and then Saturday's day 3, you want to try to do your trading at the beginning of the week. And if you're going to do anything in the latter part of the week, you want to be very, very light-handed and not have a lot of leverage on. And don't trade a lot. Get one good setup, be content with that, and paper trade the rest of the time. There's nothing wrong with that. Tapery, don't even push the demo. Just observe it. Just try to do it at the beginning of the week. So that's a week when we can do what? Trade on Mondays. Now, if Jackson Hole Symposium starts on a Monday, or any one of those 3 days of that symposium is on a Monday, you don't trade a Monday. Absolutely don't trade it. So I went long. And then later in the afternoon, I went short. Six contracts or so I came out, and then I got stopped out on the bounce of here. So I covered 5 and one more, and then the trailed stop loss. I was giving it room to see if it can overlap a little bit of this. I was hoping that the new day opening gap would keep it at bay, and then finally it stopped me out right there. That's where stop loss is there. Shorted at a really good level based on sound logic. Added to it based on sound logic, good risk management, no over leveraging, no crazy town like frequency of trade, and then targeted liquidity. Majority lion's portion of the move taken below old lows, where smart money traders are going to distribute their short positions. And then I allowed the market to come all the way back up. Now, truth be told, I wanted to see it come down here, and I was going to start doing partials right in here. I would have took one off of the remaining 4, and I would have took one more off below these lows here, and I would have took one off here, and then I would have had one contract remaining to see if I can get below here and then reach for the target I had. That's how I intended to trade it. But it came all the way back and got the balance of the 4 contracts of the 10 that went short here, 6, added 4 more here. Let me highlight it right there. You can see it. Look up here, right here. That is a closure, and then that's a closure right there. And then the balance of the remaining 4 of the 10 contracts were stopped out there. So that's over $17,000. Buying it long, I would have shorted it here had I been in front of the charts, but it was too fast for me, way too fast. I was thinking I was going to be able to upload the video because it was real short. I compressed it real quick, and then it took like 30 seconds to compress and make it in Camtasia, and then started on the server upload. And I came back to the charts, and I was expecting to do something in the upper half of the volume imbalance to get short on, and it just said, "Oh hell no," lower. And then I had to wait for this objective here, which is fine, because I would have wanted to short up in this area and then use the lower end to pyramid. Like I added it here, where I went 6 here and 4 here. I would have done 6 in here. If it would have offered me something on the high end above the midpoint, which is that red line, if it would have gave me another fair value gap to trade into, or institutional order flow entry drill, I would have went short on that. Or if it would have traded back up into this wick, half consequent encroachment, I would have added there. And then as it broke lower, the last pyramid entry would have been trading what I have here. If it would have given it. It may not have given it though. But that's my thought process. So I can say that to you because you can see my executions here. You can see my other executions. You can also see how I'm calling price action live, giving you the details of why it should behave a certain way and why it shouldn't behave a certain way. And then you watch it pan out.